Next, we will cover fixed income cash flows and types. A bullet bond. The most common bond cash flow structure is the standard fixed income bond, also known as the bullet bond. So bullet bond is just a plain vanilla bond, simple as that, and that it is a fixed coupon and not a floating rate coupon. The issuer receives the principal at settlement, making periodic fixed coupon payments, and repays the principal at maturity. So this part is pretty straightforward. As of now, the viewers should be very familiar with this. Most government and corporate issuers use bullet bonds for debt financing, and investors often prefer them for their fixed income stream at set maturity, which help fund known cash flow needs. Amortizing debt. Fixed income instrument that periodically retire a portion of the principal before maturity allow borrowers to spread payments more evenly over the life of the instrument. In this case, rather than the bullet bond, whereby you pay a fixed coupon rate every interval, now you pay the coupon rate, which is the interest, plus a part of the principal. So in most cases, that would mean that by the end of the debt, amortizing debt, you will have paid off the whole principal as well. So you will not have a final principal repayment. The most common examples include commercial or residential real estate mortgage loans. Investors, mortgage loans, we all pretty familiar with that. And we'll cover that more in depth in our real estate series. But basically, is what we're covering here is exactly the same as what we will be covering in the mortgage loans. Investors in this amortizing debt receive near-term cash flows compared to bullet bonds and face lower credit risk because the borrower's liability decreases over time. Lower credit risk is because you're getting back the principal periodically, which means that you will lower the amount of money that you actually lend to the issuer. So say if for amortizing loan, the issuer actually default on the loan versus a normal bullet bond is less risky because you already get part of the principal back. And especially if it's nearer to the maturity, you get most of your principal back versus a coupon paying bullet bond, whereby the lump sum of money, the huge sum of money at the end, it's still you still haven't gotten it back, and you still have a chance that you might not get it back, which is the credit risk. Which is why you have amortizing debt in the first place, because the lender is worried that you might not be able to pay the lump sum at the end of the day. For a mortgage loan, it's because the people that are actually borrowing are normal people and not companies, and it's for the purpose of purchasing a property, which is eventually a property that you are going to live by yourself. So it makes sense that you fully pay the loan after a certain number of years. But whereas for normal bonds lending, is corporation doesn't actually pay off at the end of the term of the bond, because you can easily roll off the debt by borrowing. When the maturity comes due, they will borrow again and to pay off the existing debt with a new debt. Even though for amortizing debt, you get back the cash earlier, which includes the principal, you would have reinvestment risk in the sense that getting the money back early. Okay, so for example, for a mortgage loan, if the bank were to get the money back earlier, they will have to worry about to reinvest the cash. Reinvestment risk in the sense that if the interest rate would have come down by then, they can only reinvest at a lower interest rate, which is a risk to the bank. At the end of the day, it's a balance between credit risk and reinvestment risk. How do you calculate the amortizing payment? For a bond, It's just the coupon rate. So every monthly, every payment for a semi-annual bond, it will be every 6 months. The payment will just be the coupon rate. At maturity, you'll pay off the final coupon with the whole principal. But for amortizing, you'll be paying off part of the principal in every payment. At maturity, you'll pay off the last payment. And the key part is that the payment is the same throughout the whole term. And the periodic payment can be calculated using this following formula. I will show you the derivation of this formula in the next few slides. But for now, we just have a few of this particular example. The fully amortized VRWA bond is a 5-year bond with a semi-annual coupon rate of 3.2% and a par value of USD 300 million. So the par value, this is the face value. It just means that the company is borrowing 300 million, 6 months. You would have this, because it's an annual rate, so you divide it by 2, you multiply it by the principal, and you have this formula, this denominator, where you also divide it by 2, and this is multiplied by 2 because it's a period, it's a 10 period, there's 5 years semi-annual. And doing this calculation gives you a final value of 32.7 million. So for 300 million and a coupon rate of 3.2% just means that it constitutes a payment of every 6 months, 32.7 million. So for 10 periods, paying 32.7 million will give you a present value of USD 300 million, which implied a yield to maturity of 3.2%. We will see the derivation of this formula. So P is how much you will pay for the amortizing debt. So in this example, it will be 300 million. Fair pricing, it just means that all the payments, A is the payment that we want to calculate. So by discounting for this 10 periods in total, it should give you 300 million. So we can just take this A out of as a common factor. So you just have this part. As you can see, this is a geometric series, right? You have this is summation, and basically this is there's a formula for a geometric series. I believe it's in the next slide. For the geometric series, you have this finite series here, and the equation that you get, it will result in this equation. We're not going to go into the derivation of how you derive this equation, but for now, we just take it as given that this is what you get. But you have a constraint here where r is not equals to 1, because if r is equals to 1, the denominator will go to 0, which means that you're dividing it by 0, which is undefined. And you might be asking, oh, what happens if r is equals to 1? Because if r is equals to 1, then this will all just become a. So it will be a plus a plus a plus a, and it will just be NA, which means that you don't actually need to have this formula. Another one would be, what if you have an infinite series whereby you have this geometric series without n and n? In that case, it will be the same equation whereby you have a limit whereby n goes to infinity, but with the added constraint, then the absolute value of r is less than 1, which means that r is not a number bigger than 1 or less than -1. And the reason is because if r is more than 1, this will blow up to infinity. And this will no longer converge, and you will not converge to this value. This will make sense because the reason why you want to sum an infinite series is you want it to converge to a certain, to a finite number. And because if absolute r is more than or equals to 1, this will just blow up, and it will not make sense to have a converged finite number. Anyway, let's go back to the amortizing debt. So as you can see, in this case, the little a is the big A here, and the little r is just a unit here, which is 1 over 1 plus r over 2. As you can see, this whole thing is square, and which is like this and this square, right? So you can employ the geometric series formula here. And this is the formula that we will just plug it in and simplify it further. And if you remember that the thing that we want to calculate here is the payment, the periodic payment. So we have to move A over to the left-hand side. And this is the final equation that we got. Remember, this is the equation we employed over here. This is how you get the payment for the amortized debt. This is an amortizing debt schedule. So let's just calculate how we can come up with this payment. As you can see, the earlier payment that we calculated, 32.7. So that this is the column. And this is the same payment for a total of 10 periods. And this is the beginning balance. This would pretty much decrease as time progresses. Note that the interest decreases as time progresses, while the principal component of the payment increases as time progresses. So for each payment, it will consist of interest and principal payment. But how do we actually distinguish between these two? Remember that the interest is 3.2%. And the semi-annual, so this will result in 1.6%. And 1.6% divided by 100, so this will get you 0.016. And multiply by the initial beginning amount, which is 300, this will result in 4.8. So this is the interest. So you're actually paying 1.6% semi-annual rate on the 300 principal, result in a 4.8 interest payment. But remember that your amortized debt payment that we calculated was 32.7. So 4.8 of it goes to interest, which means that the difference will be 27.90 goes to the principal. So as you can see, 32.7, so subtract the 4.8. So this will give you 27.9, which is the principal part. And the 27.9, if you subtract from the 300 minus 27.9, so you have a remaining principal of 272.10. So this is the part that you pay back the part of the principal. Okay, now we calculate the new interest from the remaining principal, which is 272.1. It's multiplied by 0.016. This will result in 4.35 interest. Remember, the interest was higher at 4.8. Now it's lower at 4.35. And so as you can see, as you pay back more and more of the principal, your interest will go down. So that makes sense, right? Okay, now, so from this payment, you minus 32.7. So this is 28.35. So this is the principal component of the payment as you subtract the 4.35. And then if you use this and you offset the remaining principal, because it's a negative number, I'll just add it for simplicity's sake. This will result in 243.75, which you can see here. So as you pay off lesser and lesser of the as the interest component decrements because of the reducing principal, keeping the payment the same as a fixed, your principal repayment will naturally increase. And just doing this based on the formula that we've seen earlier, it has to approach zero. So now we have because of this round-off issue, we don't really see a zero number here. I suspect the case is because every computation we calculate, because as you can see, there's a lot of decimal point, right? Or we only keep 2 decimal places, which result in a non-zero value here. But as you can see, you pretty much get the idea. But of course, for a real amortized debt schedule, you need to make sure that this number comes down to zero, because the notional amount is 300 million, which anything that is not zero would be a very high amount. So we need to make sure that it's zero. So both commercial and residential mortgages exemplify fully amortizing loans, wherein borrowers pay regular installments comprising both principal and interest. This is what we have been saying all along. And the structure ensures a steady, predictable cash flow, which is advantageous for borrowers. Okay, remember I said that for the lender, they prefer that you don't return the principal back because they will have reinvestment risk. But for a borrower, it could be advantageous because it's a more predictable cash flow, and you actually reduce your leverage as time progresses because you're getting back more and more of your principal back. But then again, that could not be a good thing as well if you want to have a constant leverage. Anyway, commercial borrowers find it beneficial for aligning with rental or lease income, while household appreciate its synchronization with personal earnings. So in this case, you have a fixed, the case of rental, a fixed mortgage payment. It makes planning a lot easier, especially if your income is fixed and you can plan it more easier. Two common bond amortization arrangements are sinking funds, often utilized by government corporate issuers, and waterfall structures prevalent in asset-backed securities and mortgage-backed securities. Sinking funds is okay. So sometimes there's a provision for the company to have a sinking fund. So a sinking fund is a fund that is set aside so that the company can pay off the principal back. So they will have to contribute to the sinking fund, and over time, so that at the end of the day, they are able to pay off the principal. Because if you remember, for a bond, the principal is a lump sum amount at the end, which will be huge. So sometimes the lender might be afraid that the company might not be able to pay back, right? Sinking fund is set aside so that eventually that you will pay off the principal as well. Waterfall structures we will see in later slides. So okay, sinking funds involve issuers in setting aside funds in an escrow account to retire bond principal periodically, reducing credit risk by increasing reinvestment risk due to the premature principal reduction. So this is paying back the principal and the same reinvestment risk that we are talking about. For instance, issuers may randomly select predetermined principal amounts for early redemption or repurchase bonds before maturity at fixed price. So this is the part that you early retire some of the bonds. And what the company will do is they will put in the money into the sinking fund, and depending on how it's used, the sinking fund will eventually buy back some of the bonds. And these are like prepayment in the sense, like a mortgage or a prepayment. So the lenders would have the reinvestment risk. And then the issuers may randomly select predetermined principal amount. So note this part where it's randomly selected. So the bondholders, they are being randomly selected in this case. Waterfall structures determine cash flows timing to investor classes with different priority claims. They are divided into different seniority, and in this case, it's different tranches. So the first tranche will be the first to receive the principal. This is we cover more in the future because these are like securitized mortgage-backed securities, whereby you split the loans payments into different tranches. So each tranche would, like for example, the principal, the first will be to receive the principal, be tranche A, followed by tranche B and C. And this will result in different interest rates and different qualities, characteristics of the tranches. This will become clearer in the future. But for now, all we need to know is that, okay, this is an asset-backed security. So the assets could be loans, such as credit card loans or other receivables, or it could be just a mortgage-backed securities. And the reason why this is categorized under amortizing debt is because we want to reduce the principal over time. So certain tranches, like bond investors that buy a certain tranche, they might be more worried about the credit risk, so they want their principal back. And the tranches at the bottoms are for investors that they don't really want to get their principal back early, but that means that they will have more credit risk in that regard, which means that the interest rate that they get will be higher, more than in the future.